Something unexpected just happened in the U.S. economy. The latest jobs report showed the United States lost 92,000 jobs in February. And now the big question is this: how will the Federal Reserve respond? Because the answer could determine where mortgage rates go next. And what happens to the housing market in 2026? The February jobs report surprised economists across Wall Street. Instead of adding jobs, the U.S. economy lost 92,000 positions. That's a massive miss compared to expectations of roughly 60,000 new jobs. At the same time, the unemployment rate rose to 4.4%, up from 4.3% in January. And the data didn't stop there. Previous job growth estimates were also revised downward by 69,000 jobs, which means the labor market might be cooling faster than policymakers expected. Several sectors drove the unexpected decline. Healthcare employment dropped by 28,000 jobs. But much of that decline was linked to strike activity, meaning some of those jobs could return. Federal government employment also continued falling. And the technology sector saw additional layoffs. So the big question for the Federal Reserve is this: is this a real economic slowdown, or just a temporary disruption caused by strikes and winter storms? The Federal Reserve now faces what economists call a two-sided risk. On one side, the labor market is showing signs of cooling. On the other side, inflation pressures are still very real. Energy prices have surged again, with oil approaching $90 per barrel as tensions rise in the Middle East. And that creates a serious dilemma. If the Fed cuts interest rates too soon, inflation could surge again. But if they keep rates high for too long, the economy could slow even further. Because of this balancing act, the Federal Reserve is widely expected to hold interest rates steady at the upcoming meeting on March 17th and 18th. That means the federal funds rate will likely remain between 3.5 and 3.75%. Fed officials have repeatedly emphasized one important point: no single month of data determines policy decisions. In other words, they want to see a longer trend before making a major move. Another interesting factor is how the Fed interprets the numbers. Historically, Fed Chair Jerome Powell has suggested that initial government job estimates can sometimes be off by about 50,000 jobs. So the Fed may actually view the negative 92,000 number as less severe than it appears. That means policymakers will likely wait for additional months of data before deciding if the labor market is truly weakening. Financial markets reacted quickly to the report. Traders are now betting that the Federal Reserve could begin cutting interest rates as early as July 2026, and some analysts expect 2 rate cuts before the end of the year. But there's one complication. The Fed has now entered its pre-meeting blackout period, which means officials won't publicly comment until the March 18th decision. For the housing market, this matters a lot. Mortgage rates tend to move based on expectations for future Federal Reserve policy. If the labor market continues to weaken, mortgage rates could gradually move lower later this year. But if inflation remains elevated, rates could stay higher for longer. That means buyers waiting for dramatically lower mortgage rates may need to stay patient, because the Fed is clearly not ready to rush into cuts just yet. So here's the bottom line. The February jobs report showed the first real sign of weakness in the labor market, but the Federal Reserve is likely to wait for more data before acting. The next few months of economic reports will be critical, because they could determine when the Fed finally begins cutting interest rates, and where the housing market goes next. If you follow the housing market, or you're planning to buy a home soon, make sure you subscribe, because the Federal Reserve's next move could change the entire 2026 housing market outlook.
Your ultimate hub for real estate insights, breaking news, entrepreneurial wisdom, investing strategies, and self-development hacks. If you're ready to expand your mind and stay ahead of the game floor, you're in the right place. Subscribe now. Your future self will thank you.